Hello everyone and welcome back. In today's video we are going to talk about time charts and the importance for both short-term plays and long-term plays when buying stocks, crypto, or any other security. They are also super important to see what's going on short-term and long-term with any asset. If you find value in this video, please like and subscribe, and with that, let's talk about how to use time charts when trading. So before buying an asset, it's important to see what's going on both short-term and long-term. Although you might be planning to be in the security short-term, it's important to know what's going on in the long-term as well. Let's say we are trading on the 5-minute chart and we see signs of a positive uptrend. We see the MACD has a bullish convergence. We see the EMA lines are in the correct order. And we see the RSI is in the fair value column. But if we zoom out to the 3-hour time chart, we see the MACD is in a bearish divergence. We see the EMA lines are in a tangled, mismatched order. And we see that the RSI has been overbought for some time. This presents a risk even in the short term. So looking at Amazon on the 5-minute chart, we see that the SMA line has been breached over here. And it goes up, and then eventually the EMA lines are in the correct upwards order. And then it continues up a little more, eventually goes back down, and then you see this pattern of going up and down of positive EMA patterns and breaking the SMA line. So one could think, oh, this is a very bullish signal on the 5-minute chart, which it is. However, if we zoom out to the 2 to 3 hour chart, now looking at the 2-hour chart, we see that the uptrend does not last long. It would be considered by many a dead cat bounce in this region right here where we saw the 5-minute chart. You also see that there's crossing of the EMA line, so that is a very bearish signal that there is about to be a downtrend, in which you see again, you see here, you see the 200 EMA line cross through the 50 and the 100 EMA lines. You can see that the SMA lines are breached, but there is resistance on the 200-day EMA. So in comparison to when the EMA lines on a long time frame are not in a downtrend, it's easier to make money in the short term than as opposed to when they're in the downtrend on the long term. Turning over to Ethereum Classic, we see the same thing, breaking of the SMA over here, then the EMAs become in the correct order, but then eventually it crashes down again, and then we see this wavy pattern till ultimately going to the downside of getting rejected later on the 200-day EMA. If we were to zoom out again to the 1 hour, in that same time period, August 3rd to the 4th and 5th, we see this sideways price action with the price action hitting the 50 and the 100 SMA line and getting rejected, and it's in the incorrect order, as you can see. So looking at just the 5-minute chart, you may not see that overall that the asset is going into a sideways price action. This is not to say that you can't make money during a dead cat bounce, because I have made money during a dead cat bounce and during a sideways price action. However, you have to be in and out. You can't be in there for very long. It's like robbing a bank. You get in and you get out. Now, with all that being said, let's look at the opposite example, because the opposite can be true as well. If we look at Google as an example on the 5-minute chart, we see that there was a breach of the SMA line. It goes down below the purple SMA line and below the 100 EMA. It goes back up and then quickly goes back down. And looking at just that, you would think the price action is probably moving sideways. Again, if we zoom out to the 1-hour chart, however, we see there's an uptrend with support at the EMA line, the 20-day EMA line. Your trading style and how aggressive you are on profit seeking will determine which time chart will be your dominant one. If you're a day trader, you will most likely use the 3-minute to 15-minute, even the 1 to 5 second time charts. I day trade Ethereum Classic as an example on the 15. If you're a swing trader, you might use the 1 to 2 hour time chart. Longer term swing traders, you will most likely use a day chart. Again, I highly recommend you use both long and short-term charts to see what's going on before making a purchase. Also, I want to give a quick tip on candlesticks and their wicks, especially on the 1 hour chart, but this applies to all time frames. A lot of times at the beginning of an uptrend, a green candle will shoot up really high, usually during a market open for stocks. Then later, we see a pullback. You see it on Beyond Burger on July 28th at opening, 6:30. You can see it shot up decently high and then has some pullback. I know I and many have bought at the top of the candlestick only to see it come back down shortly after, and this causes a lot of frustration. Even though you believe it's an uptrend, you'll most likely make a profit. What I do is I usually wait in the later half of the hour before buying so I can see that pullback and get a little bit of a better price. Of course, this doesn't always work out, but I've seen it so many times I just wait towards the end of the hour. Well everyone, I hope you got great value out of today's video, and please like and subscribe. Again, thank you for watching, and until next time.